Let's get real.
Welcome to the Daniel Steve Podcast. Steve Keene.
Good to meet you.
Let's start with most people think banks lend existing money. Walk us through step by step what happens when a bank makes a loan.
Yeah, well, when you and I make a loan, and this is important to get people aware of, can you lend me $10 for lunch type stuff? When you do that sort of thing, your bank account goes down and the recipient's account goes up, and therefore there's no change in the total amount of money. When a bank makes a loan, the thing that makes a bank different to any other type of business is a bank takes deposits, of course, and people think that's how they get money in. But the fact they create deposits, they can also create assets for themselves at the same time. So you and I can easily create new liabilities for ourselves. We can promise to do something. We can't create new assets at the same time. A bank can. So if you have a loan, if you have somebody who wants a loan to buy a house, for example, then they will go to the bank and they might have to put it used to be a 30% deposit. These days you can get away with a 5% deposit. Let's say the place is sold for $1 million, or that's the target price. They bring in $50,000 and the bank says, we'll lend you $950,000. And to do that, what they do is they put the amount in $950K, let's say, in your bank account, and they simultaneously record that you owe them $950K. Now, what that means is they've created money because your deposit account is part of the money supply. The total of money supply in the economy is fundamentally the sum of the amount of money in bank accounts plus a small amount held in cash and coins. And they've created $950,000 of that. And rather than an account going down to enable them to push your money up, which is the situation that applies when one non-bank lends to another non-bank, they increase their assets and increase their liabilities at the same time. And that's how they create money.
And so what you're saying is they've got like an app on their phone that they can just make money. They can just make money.
Well, the funny thing is Musk. One of the funny things about Musk's sortie into government when he was running Doge was that he said they found there were 14 computers which he called magic money computers, and there might be 14 of those in the public service, but there's 14,000 of them in private banks. Because once you're approved as a bank, once you've gone through the regulatory steps to be approved as one, then you're allowed to both give people what your liabilities, a bank deposit is a liability of the bank, but also create assets. And that's the fundamental thing. It's not lending out of nothing. You often hear this expression, out of nothing, or banks lend out of nothing, that sort of thing. Or they make money for free. That's not true. There are obviously costs in running a bank, okay? So there are costs in creating money that way. But the fundamental difference between a bank and any other type of lender is for other types of lenders, they have to lend out of something. Okay. Mm-hmm. Now, when they say banks lend out of nothing, what they don't mean is they use magic to create it. They use double entry bookkeeping. And they record an amount of money they've given to you, which is their liability. Now, $950,000 loan, but they also increase another account, which is the loan they've created to you as their asset, and they move them up at the same time. So it's out of nothing, but it's being created because something else is increasing. So rather than one going down, another going up, both go up, and that's the essential difference between a bank and any other type of lender.
So how is this distinction important between how money is created versus how money is lent if you physically have money? How is that important for understanding the economic booms, the bust, and the financial crisis?
Well, fundamentally, we live in a capitalist economy, and the objective of people in capitalism is to get as much money as possible. If you say that if you treat banks as the conventional textbooks do, as just what they call intermediaries who enable savers to lend to borrowers, then there is no money creation going on there. And whatever the banks do is independent of what happens at the macroeconomy. But in the real world, and this is why I'm so pissed off with having to explain this, because it's myths by textbook textbooks that create this confusion. In the real world, banks create money, and that is part of what that's an essential part of a capitalist economy. So because they're creating money, and because the objective in capitalism is to get as much money as possible, banks are a critical part of that. And if you leave them out of your analysis, as mainstream economists do, you really have no idea of how capitalism functions. And that's why it's so frustrating that the conventional economists are perpetuating a myth that banks don't actually lend money in their models. Yeah, it's crazy.
Well, so how does the Federal Reserve, what's the Federal Reserve's role in this process? What does the Federal Reserve do, and what does it not do?
Yeah, the fundamental role of the Federal Reserve is to be a settlement system for the banks themselves. So that if you strip them of all other functions, that's the one function you wouldn't want to get rid of. That banks, if you bank at Wells Fargo and I bank at Barclays, and then I buy something off you, then there's got to be a transfer of funds from Barclays to Wells Fargo to enable that transaction to occur. So the role of the level of private banks enable individuals to conduct commerce between each other, and also they create money with the loans. The central bank enables banks to do business with each other. So that's a critical function in a capitalist economy with lots of individual private banks. So that's the role they have to have. The trouble is that they're dominated by mainstream economists. And they also, because they believe mainstream economics, they believe they can manipulate the economy by controlling the rate of interest. And that'll change the level of economic activity. And that's a complete myth. So I would...
That's not why they were created.
No.
I have a short list, and people, that's one that's not designed to do, not to actually create economic growth or solve the, wage and income and housing problems, as you said, by messing with the interest rate. From what I understand, it was only created to avoid to save the banks if there's a bank panic.
Yeah. I mean, people have their own mythical histories that they make up about how things come about and what banks actually do. If you take a look back at the 19th century, you see that there are regular financial crises about between every 8 and 15 years, roughly speaking. There'd be what they called a panic in the 19th century, and particularly the UK and America. But those panics would mean that some bank had lent enormous amounts of money for some venture, like putting railways across the continental divide, and then those railway companies would fail, and then the bank that lent the money would also fail, and there'd be a collapsing economic activity. And you often needed, you really didn't want to have the depositors being trashed by what the management of the banks did. So you needed a clearance system for that, because we all bank with different banks. So to enable transactions to occur, there has to be some central clearinghouse. That used to be provided by major corporations, financial corporations like the Rockefellers and the Morgan Stanleys and so on. But the Federal Reserve was created in 1913 after yet another major financial panic. And then a major role that it had was going to be the agency through which individual banks settled the accounts that they had generated by people for banking with different banks buying and selling things off each other. So that clearinghouse function was absolutely critical. And it was a major part of having a more stable 20th century than we had a 19th century.
Stable in terms of the banks collapsing.
Yeah. I mean,
not necessarily stable in terms of the perfect world to live in.
Oh, God, no, anything but. But in terms of the instability we had of the banking system in the 19th century, didn't completely disappear with the Federal Reserve. It wasn't just the Fed that was an important factor there. It was also the size of the government sector. But if you look back at the 19th century, and I see people doing this all the time, they'll look at the price level in the 19th century, and it's basically a flat line. And then they see the price level in the post-World War II particularly. It's not the 20th century, but then it starts being price level rising. It's pretty much 1945. They see this rising price level and they think, oh, look, we had massive inflation courtesy of the central banks and courtesy of big government. We had price stability beforehand. Take a closer look at the numbers. No, you didn't. What you had massive periods of inflation followed by massive periods of deflation. So the private sector would lend into some venture, let's say it was the railroads again. Everybody would dive in and pile their investments on top of that. So you'd be having people building towns along the way and transportation and water and so on. As part of it, there'd be a big boom coming out of the whole thing. Everybody's putting up their prices. Then you have one of the companies fails, it can't pay its bills, the collapse cascades through the whole system, people start slashing their prices to try to get business in through their doors. That slashing prices reduces economic activity in general, and you go from booms to slumps. Massive inflation to massive deflation. That was the 19th century pattern. We've had relative stability because we've still got a bit of inflation occurring, less inflation in terms of the maximums than occurred in the 19th century, but there's no deflation. So you have prices going up a bit but not falling, whereas in the 19th century there were really big ups, really big downs, and that was, as I said, they called financial crises back then, they called them panics, and they called them panics for a reason. Everybody was panicking. Am I going to end up in jail if I can't pay my bills?
So is the Federal Reserve private or public? Is it government or is it private?
America always has these weird bloody algorithms that no other country is stupid enough to do, where the private sector tells the government what to do, and then you have a public institution with private management. That often happens in America. So the Fed's one of those weird hybrids. But if you actually want to say who owns the Fed, the answer to that question is who gets the income from the Fed, and the answer there is the Treasury. So even though you've got these quasi-private, quasi-public institutions and all the regional banks and all that sort of stuff as part of the Fed, the money, any income made by the Fed gets remitted to the Treasury. So in that fundamental sense...
one thing that's different in America, and I haven't found it to be true in other countries yet, is these regional banks you describe who must... the way I understand the history is when the Federal Reserve was created, J.P. Morgan got these bankers together, and as you say, we're going to have these regional banks, 12 regional banks. And he needed them to buy in, so they have to buy stock.
Yep.
And their incentive in America, anyhow, is a dividend. And while it's true, it's very complex to figure out how the system works, because part of it is true. In America, they give back a lot to the Treasury in a good year. But they still make a dividend. And even if it's only 2%, I'd take 2% because, and then I question, this is why in America, it's maybe, is it public or private? Giving money back I give money back to the Treasury every year when I write my tax check for the IRS. It's it says payable to U.S. Treasury. Does that make me a federal instead of a private institution?
It makes you under the governance of the Treasury, and that's the same thing applies to the private banks. So they don't necessarily own you, but you've got obligations to them. So like I tend to work again, because I work from first principles, I work from what's not idiosyncratic about banking in different countries. America's got an idiosyncratic banking system. So are the Brits to some extent, because the Bank of England was formed to take over the debts, I think, from the Napoleonic War. And things like the consols were to consolidate Britain's debt at the time, British government debt. So all these things are quirks out of the political nature of both countries and the fact that they were empires for a substantial period. But generally speaking, central banks are owned by the treasuries of those countries, and they're fundamentally conduits for the treasury's interaction with private individuals, because when the Treasury spends money, that ends up in private bank accounts. When it taxes, that comes out of private bank accounts. And the structure of the central bank is to be the intermediary between the Treasury and the private banks and then private individuals. And fundamentally, people talk about the Fed's creating money. It doesn't. At the pure level, it enables a transfer of funds from the Treasury's account to the reserve accounts of banks and vice versa. And then that is what enables the Treasury to put money in your private bank account or take it out.
Right. The banks, as you said, the local banks with their accounting system, the balance sheet, they're the ones creating money.
Yeah. Although the government also creates money. And this is a huge confusion that you can see. People, Musk and everybody else on the planet virtually, thinks that the government is borrowing from the public when it sells bonds to the public. And they think that the government effectively can't create money or has to borrow what it spends. And that's just false when you look at the double entry bookkeeping. And that's one thing which I've done, which is a unique.
Yeah, so explain
contribution
that
I've
process. That's
Yeah.
something I still get confused on.
Well, how about I show it to you in Revel? Can we do that? Okay, because that's probably the best way to go about it.
And while you're bringing that up, I'll tell you what I understand and where I stop understanding it. I got the point. I go to the bank. I get a $1 million loan on my house. The bank makes up $950,000 for me locally at the bank. Where does these treasury bonds and the debt, the national debt that's trillions of dollars, how, and then the Federal Reserve's in that picture somewhere, a piece on the chessboard that I don't quite fit with my bank loan.
And that's why I've built Revel to make this obvious, because one of the two key features of Revel is the possibility to model financial transactions using double entry bookkeeping.
I listened to some of your podcast YouTubes, and you talk about differential equations, which is when more than one variable's changing at the same time.
Yep.
And classic economics, which just uses a supply and demand line. They're linear, only one thing's changing at a time. That's why you can't predict reality with it. But you're using differential equations and other kinds of math.
Yeah, which is the stuff that engineers would expect other people to use.
That's where the economy is complex. You would expect that.
And they don't. Okay, they use algebraic equations. This is one of the, you'd know the name Jay Forrester, engineer.
Okay.
And Jay Forrester invented system dynamics. So he was based at MIT, and he actually took a look at what economists did. Jay Forrester was involved in building the servo mechanisms for the weapons on the American warships in World War II. So when you're firing a gun on a ship, obviously the ship is moving up and down on the ocean. So if you try to aim at a particular point, you want to compensate for the fact the wave, you're going to get hit by a wave that's going to make where you've aimed for won't be where you hit. And so he built the servo mechanisms to enable those guns to be aimed at a target and still hit the target, despite the fact that the ocean surface was moving. And he then got a position at MIT in the management department and looked at how economists modeled the economy and was horrified to find they were using algebraic equations rather than differential. So he then invented system dynamics, and that's where packages like Simulink, for example, you can trace Simulink back to his work.
Hey, one quick myth I wanna address or question before we get into math. Some believe that the Federal Reserve, this is real common now in America. Like for years, everyone thought the Federal Reserve was literally the government. And now they believe it's not, but they think that's good because the logic is it's insulated from politics. Thank you.
Yeah.
Okay. Yeah. Well, continue with that. Explain why that doesn't make to me. That's
well, they're the ultimate politicians because run by economists. They've got a vision about a capitalist economy, the free enterprise market economy being the best possible system. And in their model, ironically, the government actually makes things worse all the time. So the Federal Reserve is run by economists to believe the world would work better if there was no government at all. Okay, so in that sense, whether you think that's good or bad politics, that's clearly politics, and that's built into what students get taught when they learn economics at university. So the fundamental concept that economists work on is the idea of supply and demand. Demand curve. The more expensive something gets, the less people are going to buy. Supply curve. The more people produce, the more it costs to produce. So the supply rises. They use that for everything. Okay. And they apply that to banking as well. And that's one reason
But is the Federal Reserve was it made independent? Is it good for it to be? Is it even independent?
No, no, it's not good for it to be independent. Not be good, because what the conventional theory teaches is that leave a market to itself at a reach equilibrium. Right? And if you have any intervention at all, you move off the equilibrium point, therefore things are worse. And that intervention includes anything from trade unions to monopolies to the government itself. So the neoclassical economists are trying to eliminate the government all the time, which is fundamentally aligns them with libertarians in that sense.
So you're saying it'd be better if it was not independent, the Federal Reserve. If it was, in fact, it should be government owned.
Yeah, but because the people who run it don't understand the economy. This is one of the great ironies, and this is why, anybody who swallows Milton Friedman or any of the mainstream are swallowing a set of theories which are just fallacious. And because economists, neoclassical economists, all come out with the same branding. They believe in supply and demand, and they fundamentally believe the market economy works best without any intervention, end up being anti-government. Now that'd be good if it worked, but it isn't.
So what problems are people expecting the Federal Reserve to fix? In your country, in my country, you have a Federal Reserve, we have one. What are people, because you read the news all the time, and it's under when they say we're going to change the interest rates up or down, you're under the impression that they're going to try to fix make things better for you. Is that possible?
Not the way they work. I mean, there's so many myths that economics is built on. So one of the classic myths is that the interest rate is the most important determinant of whether you make an investment or not. And it's not the most important determinant. The most important determinant is the animal spirits, your desire to invest in the first instance. Obviously, Elon Musk has that in spades, but also your expectations of the future. Now, if your expectations of the future are tragic, you're not going to invest. If your expectations are euphoric, you're going to invest regardless of how high the interest rate is. So
that's if you think like that. But if you just base it on interest rates, then you won't think twice. You'll just go based on interest rates.
Yeah, but the thing is, that's not the real world. People are, do have history matters. Where we are in the business cycle matters. People's willingness to invest varies, and your expectations about the future vary. But to make it the potential to model the economy using that supply and demand analysis, the first economist to do that wasn't Maynard Keynes. It was John Hicks, a conventional economist at the time, and he basically assumed that you could predict the future
based on the math, but not the people.
Well, based on a ludicrous simplifying assumption that the economy. It's complicated to get into all the reason this actually happened, and Hicks woke up to himself later. But he basically was trying to model a dynamic process without understanding differential equations. This is back in the early 1930s, before he read Keynes. And what he was trying to do was model an economy with a production economy. So he made up this idea of a hypothetical economy where the only thing being produced was bread. And what you had is have a market on a Monday, and that would then set the prices from Monday to Friday for bread. And then all bread would be sold at the price decided at the market on the Monday. And then you get to the next Monday, and the prices would be reset. But the thing he couldn't explain was, how do you make the bread? Because you can't make bread using bread. You've got to make bread using...
Well, I was like, how does he predict next week? Like, will people already have enough bread? Or will there be new wheat to make new bread with?
Exactly. All those production issues. Now, he got himself caught in a quandary, and I understand why, because I actually tackled the thing he tried to do myself recently, actually in Utah. I was there in a research project with friends, and I managed to build the model that Hicks was trying to build. So what he was trying to build is a realistic model of production and money combined together. And then he starts off with the idea of a bread economy, and that sounds sensible because we all eat bread, But the thing is, how do you make bread? You can't make bread using stale bread.
You need people. So you need the bread.
You need machines. You need a bread oven. You need wheat, etc., etc. So he by using bread as his example, because he's working with a single commodity model, and this is something which is important for people to realize, that most economic models just treat GDP as a single a scaler. The
Well,
scale
like the bread
economy.
machine is now another commodity. We got to
It's
build
another
and buy
commodity.
more bread
You
machines.
need two commodities. Okay, now but he's working with a model with only one. So he tried to get this done, and he found himself stuck in a complete hole. And he finally said, "Oh, I know what I can do. I can assume that there are three markets. Let's say a market for labour, a market for machines, and a market for money. Also, a market for goods, a market for machines, and a market for money. And if two of those markets are in equilibrium, then the third one must be, according to a concept called Volra's law, which is an idea about a multi-market system, that if two markets are in equilibrium, the third market must also be in equilibrium.
That kind of fails the ship on the water example.
Absolutely.
So the ship could be not going up and down, but it might not be moving. It might be fixed. Your target's still moving.
Yeah, that's right. It's a false rationalization, but that gave rise to what's called the ISLM model, which dominated neoclassical thought for some time. But people thought it was Keynesian. Now, that's a long-winded digression, but I realized what he was trying to do was to build a realistic single commodity model, was itself a worthwhile objective. But the mistake he made was using bread as the object, which bread makes plenty of sense for consumption, but you've also got to imagine it to be used for production. Now, you can't use stale bread to make bread.
Let me ask this now. It seems like a good point because we're talking about bread and maybe who can buy it. But the bread machines and capitalism, who gets money first? So the Federal Reserve makes sure we don't have bank crashes, but it doesn't decide who gets money first. The banks do. They decide when to lend large institutions money. So how does that affect the economy, the timing, and who gets the money first? Where does that play into all this?
Oh, I think we're getting. I think it's probably better to go back to the initial point I was making
Okay.
about. Okay, but what I might also give us a bit of time, because Ravel's a software package under development all the time, and as it happens, the most recent change introduced a bug, which meant I can't use the data analysis side, but it introduced a feature that I need to show the modeling side properly. You can't understand a system like the banking system without understanding banking. Okay, and unfortunately, that's what economists have done, because they've applied supply and demand curves to everything, including the banking. If you go and look on YouTube, I mean, there's one of my favorite little videos on that front, just to show how dogmatic economists are. Was an economist saying, "We're going to talk about the market for loanable funds." He said, "And because it's a market, you know it's going to have a demand curve and a supply curve." Instantly, these mythical objects become what they think about. They don't look and say, since it's a bank, it's going to have double entry bookkeeping. No, I might.
That prevents clarity from the start, because I don't know anybody besides you and me and one other person that understands banks create money, to say it simple. Let's put it this way. They don't have money in the piggy bank to loan.
That's right. They create it. That's right. They treat them like a warehouse rather than a factory. And fundamentally, they're factories. So you've got to have a model of how does the factory actually make the product. And in the case of banking, the factory is double entry bookkeeping. So that's what I built Ravel to do, amongst many other tasks, is enable you to model the mechanics of the banking sector. And then when you get completely different conclusions about everything compared to mainstream economics when you see it through double entry bookkeeping.
Yeah, and I like the way in your book with your math, it shows it. You get the ironic twist is when you pay back the loan, that money disappears out of circulation.
Yeah.
The money's gone now. Well, how can that be? I gave you back the money. Now it's gone. There is no money now.
Yeah.
You paid that debt off. It's like,
well, I took a while to understand that myself, because my thought was when I began modeling monetary dynamics back in the 90s as a way of building models of financial instability, Hyman Minsky's financial instability hypothesis. So I had debt in my models, but I didn't explicitly have money. And then when I worked out how to model money, it was through not quite double entry bookkeeping. I was using bookkeeping then to show that when a debt is issued, money is created at the same time. But I thought that banks are not going to let money get destroyed. So I thought the whole idea, if you pay off debt, you destroy money, that was wrong. When I did the double entry bookkeeping, it's obviously correct, because the way you pay your debt off, which is your liability to the bank, is you say, I'm going to reduce your liability to me. I've got a deposit account with $100,000 in it. You are therefore, if I ask for $100,000, you've got to give it to me. That's the bank's liability. But I'll let you reduce that by $100,000 so long as you reduce my liability to you by the same amount. And therefore, paying off a bank loan destroys money.
Mhm.
You've got to think about it in double entry bookkeeping terms. Can you let me share the screen, by the way? And I'll just, okay. All right. So this is Ravel, one of the many ways it can be used. So you should be seeing,
Yep.
okay, those 4 tables there. So this is a double entry bookkeeping view of the monetary system. And I'm going to start off with banks and say banks obviously have loans. So I create loans as an asset of the banking sector. And they also have deposits, which are a liability. So that's showing loans and deposits, and then the net worth of the bank is the gap between the value of their assets and liabilities. So let's say if there was, say, 100 in loans and there was 90 in deposits, then the bank has got an equity of 10, and that's just showing that, that's the initial situation there. Then if they have a bank loan, what that means is they're going to put a flow of money into bank accounts. So I'm going to call this flow credit. They put credit dollars per year into deposit accounts. And what Ravel does, which it enforces the rules of double entry bookkeeping. So everything has to be entered twice on the single line, and all rows must sum to 0. So I've got credit there, and the equation is the gap between your assets and your liabilities is your net worth or equity. So mathematically, in each line, assets minus liabilities minus equity must equal 0, and that's a conservation law. Ends up being a conservation law. So I've got minus credit here. I've got to have a plus credit coming in. That turns up that the bank makes that amount of money as your deposit.
Your credit,
So,
okay. The loan.
Now we come down and look down here. That's looking from the point of view of the banks. So it's also seen from the point of view of the non-banks. So what's a liability for the bank is an asset for the non-banks, and vice versa.
By non-banks,
So
you mean the people?
People.
Okay.
Okay. So I bring that across, and that's your situation. So I'll call this private sector. Private equity.
We're grouping everybody together, but it could be one person. I was thinking one person.
Yeah, so it's an entire, the entire public.
Okay.
Okay. So that's now showing it from their point of view. And when I take a look at their net worth, the banks have got a net worth of 10. Therefore, the private sector has a net worth of minus 10.
Mm-hmm.
Okay? So, and this is one thing about when you have seen from the point of view of assets and liabilities, the sum of.
I'm sorry to interrupt. I'm picturing money as physical paper dollar bills. I think I understand now when the confusion is the banks don't literally create money. Maybe that's true. They create the books. It's all on books.
It's all on books. It's all a bookkeeping exercise.
But technically, could I go to the bank and say, this is my loan, I want some cash. I want to withdraw the cash, and then that would be turned into dollar bills?
Yeah, but the cash, the bank can't create the cash, and neither can you. Okay, that's got to be created by the Treasury or by the central bank.
Piggy bank. They'd have to pull that out of the piggy bank, literally, not the paper books.
No, they print it. They print it. Okay, fundamentally, we live in an electronic system these days, and everything is electronic ledgers. That's what I'm showing here. And one of the rules you get out of this with double entry bookkeeping is the sum of all assets and liabilities is 0. So if you have banks who have assets of 100 and liabilities of 90, the net worth is 10. That means the rest of the economy comes out being worth minus 10. Right?
Okay.
You've got deposit. Okay, it's very simple to see in this particular case.
Yep.
But as I extend it, it'll get more complete. So that's looking at it from the point of view of private banks. What about government spending? And I'll make it simple by just having the government deficit. So the government spends more than it takes back in taxation. Then that means it's putting more money into private bank accounts than it's taking out of them. So I type deficit here, okay, and that's now turning up as a positive down here for the the banking, for the non-bank sector. What's the balancing item? That's where reserves turn up. So we show reserves here, and when the government, when a bank creates a loan, its liability deposits goes up and its assets of loans go up. When the government spends more than it takes back in taxation, which is running a deficit, then deposits go up, and on the other side, the reserves go up. So I put this in here, and now I've got a more complete picture. But I've still got to say, well, for whom is the reserves?
I was going to say, so on the left side of the screen, we have the actual Treasury gets a box, and the central bank has a box. So far, we have the banks have a box, and the people have a box. Now we're going to talk about the central bank and the Treasury.
So now bringing across, you've got the central bank over here. So if I bring up the fact that I'm just going to get my text right. I mean, we use LaTeX for the formatting of the program, so using LaTeX commands.
So I noticed in the central bank box, when you put government deficit, giving the people a loan, it showed up in the central bank
as well, because the reserves have increased. Reserves are an asset of the bank; they're a liability of the central bank.
Oh, I see. So the banks.
Okay, so now we look down here. The government spends more than it takes back in taxation. It's increasing your bank account. It doesn't come with any matching liability for you. So that deficit actually increases your net worth, monetary net worth. This is all in nominal terms rather than real terms. So the deficit increases the financial net worth of the non-bank sector. Where does it come from over here? Well, there's a government's got an account. I'll just call it government. The government has accounts at the central bank. So where the deficit comes from is funds come out of the government account and go into the reserves. And that then ends up down here. And you want to look at the Treasury. For the Treasury, the Treasury has the government account. I haven't got any liabilities there yet. I'll bring those in a moment. So I'll call this Treasury equity here. And so what you can see is that the government spending more than it takes back in taxation puts money in private bank accounts without any offsetting liability, which applies for a loan. So it increases the financial equity of the non-bank sector. How's it created? By the Treasury going into negative equity itself. So the negative equity of the Treasury creates positive net worth for the private sector. And the central bank just plays the role of a conduit. You can see the deficit means one account goes up, one account goes down, another account goes up. It's an account shuffle.
So we mentioned earlier, it would be better if the central banks were part of the government. Does that hold still?
This holds. I mean, it's still fundamentally the central bank is a part of the government, even with the weird American
language.
Situation.
Okay.
Yeah. Okay. But what it shows is, how does the government create that money? It goes into negative equity itself.
Mm-hmm.
Okay. The government doesn't create money by selling bonds and all that sort of jazz. It's literally the act of saying, we're going to spend more than we take back in taxation. You pass a law in Congress, spending exceeds the taxation. You're actually creating negative financial.
What you're saying is it's still just on books, like the earlier example.
It's all on books.
Just on paper so far.
Yeah,
okay.
Yeah, all on paper. And the fundamental one way that a government determines what it governs is where the government's liabilities are accepted as money. Okay, so if you try to take your American dollars and go shopping in
Europe, let's say.
Europe. Okay.
Yeah.
You have to pay people might take it for a substantial discount, but you can't go shopping with American dollars. You've got to convert them into euro. Okay. So where your government's liabilities are accepted as money is where your government governs. So in the sense of a government creating liabilities for itself marks the boundary of that country just as effectively as having customs guards marks where your boundary is and having warships to defend it and so on.
Well, so that makes sense actually, because since it's not gold or precious metal, we can't take it to another country and expect it to have the same value. The value is relative to our economy, our own economy.
Exactly. So the government, it's a fundamental function of a government to create liabilities for itself, which are used for commerce by people inside that government. And that's completely changes how you think about the government being in negative financial equity. Of course, it's in negative financial equity. Okay.
Where do the bonds, the selling of bonds with the treasury is another place I get lost.
Yeah.
What's that about?
I'll bring that in now, because this is the beauty of building up layer by layer and being able to see the whole structure, which the only program that lets you do that is Revell. So I've got the deficit here. What about the government selling bonds? Let's take a look at that, because one rule is the government is required by laws. It's not a necessary part of the process, but they're required by laws to issue bonds equivalent to the deficit plus interest on existing bonds. So what I'm going to do now is have bond sales, a bond auction. And there's the initial way that the government proceeds is it holds an auction, and the auction sells bonds which are equivalent to the deficit plus interest on existing bonds. That's part of the mechanics.
I'm smiling because I'm kind of like, I don't understand really why we need to sell bonds, but it seems kind of fishy for some reason.
Yeah, it is. It's like the easy thing would do. So the government would sell the bonds to the central bank, and that'd get away from all this confusion. But I'll build the system as it stands. And of course, when the bond auctions occur, the auctions increase the amount of money in the government's account, and they come out of the reserve accounts. So to take part in an auction, you've got to have an account at the central bank. So now I'll put that in here, this level. You can see the deficit reduces the government account, increases reserves. Auctions reduce reserves, increase the government account. If the deficit's equal to auctions, then there's no change in the amount of money in the government account. Okay? That sort of thing. But over here, I've now got auctions turning up. Well, auctions mean you've got to have, you buy the bonds. So you get bonds that are owned by the banks, and the auctions reduce the monetary value of the reserves, but increase the monetary value of the bonds that are held by the banks. So that's that little action there.
Why even do that?
Because the only reason to do it, the only practical reason, if you don't have this line here, you only got a negative entry for the government's account at the central bank, so it'll necessarily go into overdraft.
So you need the bonds to
avoid the government being in overdraft to the central bank.
Okay.
That's the real function that bonds have. And like to show the equation, I'll finish the pattern here.
I always wondered if that's where money came from, where money was created, but it's not. It's a bookkeeping. It's a way of bookkeeping.
Yeah. Again, this is why you can only see this with double entry, and I keep on emphasizing. I wish there were more programs that did it. I haven't patented this side of Revell, so if people wanted to build other programs that did exactly the same thing, they could do it. Okay, but there's the only program on the planet that enables you to do it right now is Revell, and when you put it in, you can see, well, in fact, the auction doesn't change the money supply.
This would also explain why you need a central bank and not just the Treasury to do the math. It's because of the paper, the bookkeeping on paper, not the actual money itself.
Fundamentally, it's the bookkeeping. That's what the central bank's its role is, to keep the books. That's about it. Okay, and so you can see it's enabling the deficit transfer to occur between the government's accounts and reserves, which then enables that money to turn up in private banks, which means it becomes, part of the net worth of the non-bank sector.
Now, what's the effect of a finish if you need to explain it? But I wonder what the effect of somebody like another country, China, buying up a lot of these bonds, getting their hands in the cookie jar, so to speak, in our country.
That's international trade as well. But yeah, what happens is if you have, and this is basically an asset swap. If you have China selling BVD cars to America, okay, then the BVD company back in China is going to get money sent to it, which initially is American dollars. Now they can hang on to those American dollars and decide to buy American assets with them, or they can tell the Central Bank of China that they want to hire more workers or buy more Chinese capital equipment. So they'll then instruct the central bank or an agency they're working through to sell the American dollars that the BVD has earned and buy renminbi with it. and that therefore increases the amount of Chinese money in that BVD's bank account, which means it can reinvest that money and develop its technology even further. So, but the main point, people think we're going to be over the barrel to China, and China's got all these bonds, and we're going to be driven bankrupt because China will say we want the money for these bonds, we haven't got the money, we're going to fail. That's all crap. Okay.
And why
The
is
reason
that?
it's easy to show because this is the other role of the central bank. I've got bond auctions going on here, but I can also have open market. I'll call them open market ops.
You just create another book entry. That's the way to save the country.
Well, what I can say is that you've got all these bonds which are owned by the over here owned
Or overseas.
Okay. Well, I'm going to create another asset which is bonds owned by the central bank. And if you have OMO operations, then that's going to mean that the reserves, the central bank's going to buy bonds off the private banks using open market operations. That's going to increase the assets that the central bank has. And then over here, you're going to show that it reduces pardon me, wrong case, it's case sensitive, okay, reduces the bonds that are owned by the private banks. And then for the government itself, it's now got an additional liability to the central bank. So that's, again, there's going to be a fall in bonds owned by the private banks and handed across to the central bank. Now, if you had that situation of China saying, we're going to sell our bonds, okay, the central bank could say, okay, we're going to buy them all. If China owned $100 billion, $100 trillion worth of American bonds, and they threatened to dump all these bonds on the market, the central bank, because this all happens at actually the New York Fed, the New York Fed can say, oh, okay, you want to sell 100 billion? We'll buy 100 billion off you, or 100 trillion, and they'd have no impact at all on the economy. So the central bank, being a bank, it's got both assets and liabilities. It can mark up both its assets and liabilities like a private bank can. But crucially, the central bank doesn't have to have positive net worth. Private banks have to have equities. Okay,
So what is it when I hear about the deficit, the trillions of dollars will never... Elon Musk, back to he thinks he's going to solve the problem. He doesn't understand how money is created. Makes me wonder if we went in a rocket with him and he doesn't understand how we're going to get back or something like that. He didn't think about the future. Is it just politics and scare tactics, or?
Yeah, it is. It's not understanding the accounting. This is what pisses me off, because I mean, it can be left wing or right wing, whatever. Okay, but if your politics are based on bad accounting, they're going to fail. Okay, and you look at all this panic about all the bonds that China owns, and this debt we can't repay, yada yada yada. Individuals have debts they can't repay. I don't know if you're married, but if you were in debt, your wife couldn't buy your debt off you and get you out of having to pay interest. Okay? It doesn't work that way. You can't get rid of your liability. But the central bank, because it has the capacity to mark up its assets and liabilities at the same time, it could say, well, we're going to buy those Chinese bonds. Well, if you don't like a government debt, we're going to buy all government debt, which is what happened during quantitative easing. Now, if the central bank does that sufficiently, there will be no government debt left.
Well, what is
by
that
the non-government.
QE? I saw that term in your...
Quantitative easing, yeah.
What does that mean?
It just means doing lots of open market operations where you buy bonds off the private sector. Because when you look what's happening for the banks over here in the open market operations, that means the value of the bonds falls, the value of reserves rise. So that's what quantitative easing does, that on steroids. So
why is it called quantitative? Means number, easing. It's like number easing.
Yeah, it's another misnomer. I mean, it was invented by Richard Werner, who's a non-orthodox economist who knows more about banking than any conventional economist, but he uses this term. I think he dreamt the term up, quantitative easing, and the idea was it's going to take pressure off the banking sector, fundamentally, that sort of idea. So hence the idea of quantitative easing. But it's just basically buying bonds off the private sector, off banks. And what that does is that reduces the amount of bonds in existence and increases the amount of reserves.
And in one of your articles, I read in regard to Wall Street, you call quantitative easing helicopter money.
That's Milton Friedman.
Oh,
So,
okay.
I mean, there's a paper by Milton Friedman called The Optimal Quantity of Money, which is a work of fantasy. He imagined an economy in which there's an economy that had been in long run equilibrium, all prices are stable, no inflation. They have $1,000 in pieces of paper saying this is $1. And then one day a helicopter flies over the top and drops another $1,001 bills. That's how the whole idea came from Milton Friedman, a thought experiment in a totally artificial world.
Okay.
So a bit heavy. Yeah.
Yeah, so the question of is it a fair game for who gets the money first in terms of the big bank loans?
Mm.
And I think private debt is a problem because I can't just declare bankruptcy. But in fixing things, just in capitalism in general,
Yeah.
the Federal Reserve doesn't decide who gets the credit, the bookkeeping, right?
Private banks do that. Yeah. They're the ones that do the
Private
lending.
banks do that.
Yeah.
But a lot of new money tends to reach large institutions and organizations, corporations before households, right?
Oh, yeah. Corporation. The definition of a capitalist is somebody who can get a loan from a bank in some ways. Okay? If you can borrow money for a business, you're a capitalist. So the banks, control fundamentally who gets access to money created for investment.
And does the Federal Reserve affect that at all?
Not particularly.
It's just literally your private banker who
It's
you
your
know.
private banks. Yeah, you've got to understand the dynamics of private banks as well as the government. And both of those are misunderstood by the mainstream. So the conventional economists ignore the fact that banks create money. They have a model they call the money multiplier, and that's another false model about how banks are supposed to operate. But yeah, the whole treatment of banking in mainstream economics is just completely wrong. And it's all because they don't actually go and check the double entry bookkeeping. And that's the major reason why I invented Revell.
So now I'm going to tangent into solutions a little more. The bookkeeping's fine, mind you. It's just a lot of people are in debt, can't pay back their student loans or their mortgages. They got at a bad interest rate. And this is the part where I'm still trying to understand the Federal Reserve because they set the interest rate, but it's just double bookkeeping, which might be fine. The interest is the problem. My solution, and just want to run it by you, is we used to run more on credit, literally my credit, my reputation. What if we just didn't have interest on loans? Because I can pay back my student loan, I can't pay back the interest. I can pay my house mortgage principal, I can't pay the interest. What if we just said there's no interest because we can pay the banks a nominal fee for maintaining the books? I'll pay them what I pay my accountant, but not 15 or 20% on my credit card.
Yeah.
You think that would help us help?
Well, in fact, if you're trying to do it with a private enterprise, you're trying to get a private business to try to not make a profit. Okay, that ain't going to happen. They're going to make a profit out of it. But we give the banks far too much interest on that front because we think we're paying them to be custodians of existing money. Like, take good care of the warehouse. In fact, they're running a factory where they can create money by creating debt. And because they profit out of that, because when they create a loan, they then charge interest on it, it's a major revenue source for them. So they're going to want to encourage us to have as much debt as possible. And you can see that in the figures for the 1980s and 1990s, a dramatic increase in, first of all, business debt and then household debt, all with people borrowing money to gamble on the price of shares in the 1980s and houses in the 1990s and 2000s, and we got these asset price bubbles out of it, which then led to economic catastrophe. And also, like, housing has been made so much more expensive by by the increase in the amount of money that people use to buy houses. So a major issue is that when you borrow money to buy a house, and the amount of money in existence being increased by the bank loan, which is what happens, then the monetary demand rises. You don't have any change in the bank. Houses are incredibly
It's
hard to
causing
build.
inflation.
It causes inflation in asset prices. So what maintains the current price level is the current level of new mortgages. And though it changes the level of house prices, is change in the level of new mortgages. And that's something you won't get out of the mainstream because they have this myth that the banks don't create money. When I put that together in Revell and look at the data, it's ludicrously obvious that what drives rising house prices is rising levels of mortgage debt. You've got an amplifying feedback. They call it a positive feedback in the systematic literature.
It's because the Feds are deciding they're going to fix the economy by controlling interest rates, which gets us into a mess because now I've got to pay more interest than just principal.
Yeah, yeah. And like the housing, like America is actually one of the least extreme examples because if you go back to 1970, compare it to today, house prices in real terms are 2.5 times what they were in America in 1970. They're 5 times what they were in Australia and New Zealand and the UK. So houses got 5 times as expensive compared to consumer goods, and you can all bring it back to the amount of mortgage debt that banks have created. So, and now, the average income earner in each of those countries pretty much can't afford a house.
The interest rates, right? So what would happen if this is just imaginary now, but we can do the math on it? We told the banks, you know what, we're going to allow you to process payments and charge a fee, a finite fee, a transparent fee, administrate this, but you can't charge interest. With the same housing situation we just talked about, the increase in, housing prices and how would that change if the Federal Reserve didn't actually charge interest or is literally always 1%? And that's just for a processing fee. And there's pretty much.
You'd reduce the cost of housing quite dramatically, but it's a complicated thing to do. I've actually come up with a proposal for that I called AHA, the Affordable Housing Authority, okay? Because we think that banks are the only source of money and therefore they've got us over a barrel, so we've got to pay interest to get it. But the government can create money as well by, going into negative equity for itself and creating matching positive equity for the rest of the economy. So the government could easily say we're going to create an affordable housing authority and lend to anyone who we've got to do the the credit checks to make sure they're actually people who will repay the debt they take on, but let them buy housing at a transaction cost, not an interest rate profit for the organisation. And then you could have a dramatic drop in the cost of housing because when you look at a mortgage, if you're having a mortgage and you're paying 5% interest over 25 years.
10 years, your first 10 years are mostly interest.
That's right, yeah. And it's all it's going to not going to people who build the house, it's going to the bank that financed it. And
you and I understand this now. You and I do.
Yeah, yeah.
Student loans. If we did the same thing.
Yeah.
You would just say, it's not forgivable debt because you should pay back the 1,000, all the money spent, not working for a couple of years, but not the interest. I think students could do it.
Yeah, it'd be far more feasible. And the banks, because we don't understand banks, and because we have this sort of mythical attitude to their masters of the universe garbage as well. They've managed to get debt in virtually every area. You've got to take out debt to get medical treatment. You've got to take out debt to get educated. You've got to take out debt to buy a house, et cetera, et cetera. When you look at it, the amount of money going to the finance sector has risen from about 10% of GDP in the 50s to more than 20% now. And it's just a higher cost for the rest of us to do business. It hasn't facilitated any more business. It's made business more expensive. And you've got people who take out student debt, who therefore aren't in a position to buy a house. We're suffering from debt constipation.
Yeah,
I want to find ways to eliminate it. So, just realizing how banks operate in the first place is a major step towards reforming that system.
And then I'm looking for my pushbacks because there's people who think oh well, if we didn't charge interest, there'd be no incentive for people to pay back their loans. Or people don't understand how the money's created, so they think by not charging me interest, it's not fair. I think once they understand it, everybody would understand why it's a better system. But there's this ingrained thinking in people's head that it's still the piggy bank. I gave you money, so I need to charge you interest.
Yeah, yeah. And the thing is, with this I've personally made loans that I regret. Okay, seriously regret. And when you have an individual loan, one of the reasons to justify charging interest is, well, the person who's doing the lending is doing without the money. Therefore, they're making a
There you go.
sacrifice.
That's what I'm looking for.
Okay. Now I did that with a family member. I desperately regret it for all sorts of reasons. But literally, I couldn't spend the money. My relative could, So I really experienced, and I didn't charge her interest as well, which is even another mistake. So I know what it's like. Individual point of view, yes, if you make a loan, you've got to do without the money. Therefore, you should be compensated for doing without the money. But a bank creates the money. It's not doing without it at all. It's a business opportunity for them. And therefore, you can imagine a business where it was restricted to a much lower rate of return, which affect, giving a return on the capital, okay, the bank building itself, rather than the size of the amount of money the bank has created. So there's every reason to say banks should get a far lower level of interest to reflect the cost of capital that's involved in them creating the loan, but not the scale of the loan itself, which can be far larger than the capital.
Mm-hmm. Is this your article to make America great again, write off the private debt?
Yeah.
Yeah, tell me about that. I think it's what we're speaking of. We're to reduce the household debt and boost employment. Is along the same idea?
Yeah, because banks create, most of the money created in the economy is not created by the government, it's created by the banking sector. Factor of 10 difference between the two. And when you have what you get out of this is a dynamic that can lead to a rising level of private debt over time, and that's what destabilizes the economy. This is the work that Hyman Minsky did initially verbally, and I turned it into a mathematical model of the same process. So if you have banks creating money, which is then used by entrepreneurs to build factories, and then the entrepreneurs have to pay interest to the bank, and so on, you get a feedback effect that basically means entrepreneurs borrow money during a boom and have to repay it during a slump. And because the cash flow that they expect to get is less than actually they achieve because of they borrow during a boom, they've got to repay during a slump. What you get is a tendency for the level of debt to ratchet up over time, and you can finally get to a point where the level of debt is so great that the compounding effect of the interest on that debt is not offset by what the firms can repay during the slump. They start to go bankrupt and the whole economy falls into a black hole. And that's literally the dynamics that I first modeled back in the 1990s.
That sounds to me like, again, it's the interest that's the reason you can't repay the loan.
Yeah.
It was inevitable. Compounding interest, compounding doom is coming your way.
Yeah.
And it's
once
not
you understand that banks aren't warehouses, and they're not just doing without anything to give you money. Okay, as an individual lends money to you, the individual has to have less spending power, and therefore there's a good reason to say you should charge interest on a person-to-person loan. It's substantial to make up for the fact you're doing without a large amount of money. You're giving away, let's say, $330,000, and you can't spend it, so you should get interest payment to compensate you for the fact that you can't spend that money. That makes perfect sense at individual person-to-person loans. But banks create that $330,000 out of nothing. Not out of nothing, but they're not doing without anything to create it. They're increasing an asset for themselves, which is the debt, and they're increasing a liability at the same time, which is the money you get to work with. But they're not doing without anything. Okay, so there's good reason to have a lower rate of interest than we accept.
Yeah, the bank loan officer, makes it so serious. And your credit is serious, mind you. I'm not saying we should just give everybody whatever they want. You should be
Yeah,
responsible. It should be your reputation and your responsibility. But they make it seem like they're doing you a favor.
yeah, anything but. Yeah. And again, if you look at for most businesses, the cost of capital is enormous. If you want to build cars, you got to build a car factory, have all the distribution system. There's enormous cost, and you will then relate your level of profit to the amount of capital you've invested. The amount of capital in a bank is trivial by comparison. You simply need to achieve a bank license, and these days you don't even need to have physical banking facilities. Yeah,
Right.
yeah. You can do it all in a virtual sense. So there's nothing like the level of capital involved. But if they got a return on capital, it'd be far larger than the rate of interest they currently charge.
We just opened Pandora's box into, okay, do we even need a business license? I've always wondered when Visa and MasterCard were invented,
Yeah,
who got the inside, like, hey, we're going to start a business credit card company. You can just give this to people and make up money with the books and then charge some interest. Do you know the history of how that was started, the Visa, MasterCard, and what banks and who got into it?
can't say that I do. But again, the idea of, credit's always existed. The credit card is a way of giving you a line of credit, as it used to be called. And so banks used to create lines of credit for corporations in the 1950s and 60s, and that meant that they'd negotiated a deal with a bank. Lots of banks had negotiated a deal with a major company like General Motors to say, we've given you like a line of credit that means you can withdraw $1 billion, okay, if you want to. So it's basically a decision to let you increase the amount of money you owe the bank and give you money in the process of you accessing that extra debt. So credit cards were just a way of making lines of credit more universally available. And of course, the rates of interest they charge on those cards is outrageous. It's 25%, tends to be 20% or more, whereas the rate of interest on a loan is normally the order of 3 to 5%. So
Well,
they're
because they
huge
know
money
General
spenders.
Motors wouldn't be able to do it if I charged them 20%.
They'd laugh in your face.
Right,
Yeah,
but an individual, well, first they might not really think, you know what, I shouldn't have taken this credit card,
yeah,
but they know they can. I have been told by someone who understands banking, Federal Reserve banking laws, when you apply for a credit card, you get one. The bank does the Federal Reserve banking, um, the line item in the federal bank, the way the Federal Reserve works, it's called monetarizing your signature. Meaning, maybe back to your bookkeeping examples with Revel, they literally then turn your signature into the $10,000 or
yeah,
$50,000 credit card. Basically, they've used your signature, they've turned your signature into money.
yeah. If you've agreed to a liability with them,
Yeah.
if you take advantage of the asset you can get from them by, having the flexibility to go, you don't have to have the money in a bank account. You can increase your loan to the bank, and you don't need to go and apply for the bank for a loan. You've already got an agreement with the limit that you've got set on your credit card.
But the key thing I think people don't understand is they feel bad, some people not paying back their credit card when they can't because the interest is too high. They got in over their head.
Yeah,
There's nothing.
yeah,
And they feel bad when they don't realize, you know what? It was your signature that did the bookkeeping. They never had a piggy bank and loaned you any money. Right?
yeah. The money's created by the bank. It's not something they've got to reduce what they've got to give it to you. And that's the picture that mainstream economists have nailed into people's heads in the loanable funds model, which is a fallacy. And then with that fallacy, that justifies high rates of interest, and it also means that the economists who are supposed to be experts on the economy are leaving out a fundamental part of the economy, which is the banking sector.
Right. The example you gave with the Revels was helpful. So is there anything we haven't talked about you'd like to add in terms of, I started with the Federal Reserve.
There's tons. If you want to talk about that book of mine, there's tons more in it, obviously, and a lot of it relates to the role of energy in production, which is also ignored by the mainstream. So, like again, engineers would expect that economists understand you need energy to produce output. In fact, they've made up mythical models where labor and capital alone can produce output. And I saw through that. There have been many economists before me have tried to find a way of bringing energy into models of production properly. But I got a little insight about 8 years ago, which made sense of the whole thing, that conventional economists believe labor and capital together produce output. And I had a little one-liner: labor without energy is a corpse. Capital without energy is a sculpture. So energy is the fundamental input that enables production to occur. And then that gives you a link between the economy and the ecology. And that's what I also developed.
When you
in
say
that book.
energy, do you mean like gas, oil, solar power,
Yeah.
and nuclear power?
And food for that matter as well. If you have a machine without energy, it's a sculpture. You have a human without energy, they're dead.
Okay,
Yeah. Okay.
I see.
So therefore energy is an essential part of your way of thinking. And I've managed to model that as well, which I also explain in that book.
Oh, and then you have the feedback. So I'm
Yep.
thinking power, like solar panels. People think it's free energy. I'm like, I worked at Motorola. It's a semiconductor chip. There's a lot of manufacturing that goes into a solar panel. It's not free energy, that kind of thing.
It's minerals. As a friend of mine, a guy called Simon Mychow, that I recommend you take a look at his work. Simon says with the idea of a renewable energy society is actually a minerals-based energy extraction system. Whereas oil and coal, we're digging it out of the ground and burning it directly. This is using minerals to capture solar energy and minerals to capture wind energy fundamentally.
Not free.
So, not free, no. There's the resource costs in any of this. And again, conventional economics is useless on that front. They imagine the possibility of a world without reduction without energy. Well, that's just impossible.
This is your latest book. What's the title again?
Well, that's the one called Money in Macroeconomics and First Principles for Elon Musk and other engineers.
Elon Musk, his picture's on the cover.
Yes, they're done by Grok. I was quite pleased about that little piece of work. They did a good job of making him look shocked when his rocket falls over.
And is it a spoiler alert? Do you want to save it, or can you give me one solution to to having energy in the model? When I say solution, to make the world a better place, a better place for the people who live in it.
Reality is that it explains why increasing economic activity damages the biosphere. Because if you're going to exploit energy, then you've got to dump waste into the environment. The second law of thermodynamics applies, but it's trivial right now. But a huge part of that waste is carbon dioxide. The mass of carbon dioxide in the atmosphere exceeds the mass of all living things on the planet and all things humans have built in history. It's an enormous amount of waste we're dumping in there. That's what's causing global warming. So once you realize that energy is absolutely critical to GDP, and if you don't have energy, you don't have GDP, then we can show we're necessarily stuffing up the biosphere. So we have to respect the laws of thermodynamics when we talk about how to manage the economy. And economists haven't got the first inkling about what those laws are. So we've ended up massively extending.
It sounds to me like we tangented into the classic saying, reduce, recycle. In other words, you can't escape. Recycling's not going to fix things. You have to reduce and reuse.
Yeah.
And then in terms of we live, the idea of minimalism, which doesn't mean live in a cave, but it means every choice you make has some consequence, effect.
Yeah. And that's the whole idea of system dynamics is feedbacks and what happens when you change something. And of course, economists are completely immune to that because they think in equilibrium terms rather than system dynamics. So I'm trying to move them towards what engineers do, which is think systemically. If one valve moves, something else has to compensate. And that's what Ravel is designed to do, to bring that technology to economics.
Or worse, they think there's the keyword innovation, which seems in capitalism, which seem to think the more you do, the more we make, the better.
Yeah, there's a magic attitude to innovation. But every innovation you look at, what it's made able to do is use more energy.
Right. Yeah.
So
The phones, the computers, the internet's all using more energy.
The rockets, it's all energy use. Okay. So if you don't understand the role of energy in production, you're going to enable people to produce far more in the biosphere than they should. and put more waste into the biosphere. All these things matter immensely, and they're ignored by mainstream economics.
With the Mars thing, I was shocked. First, I've come across this book. What do we do when we land on Mars? How are we going to cultivate it, build it up? I was blown away from page one. Has nothing to do with ecology and thinking ahead to prevent a mess. Instantly, boots on the ground. Where can we start mining, as you say, mining for stuff? I'm like, wow, guys, already like not thinking ahead. And I wasn't really impressed. Just get there and conquer, and not worry about it.
There's a guy called James Buchanan who was a non-orthodox economist back in the 50s and 60s, and he made a comment at one stage: anybody who thinks they can have infinite life, infinite growth on a finite planet is either a madman or an economist. Now, like when you look at Mars, obviously you want to dump carbon dioxide into the atmosphere. You want to increase heat retention. There are things you want to do to that planet because it's, as Marx said, it's a fixer-upper. But we landed in the Garden of Eden and we're trashing it. And that's the main danger. If we continue trashing it, we won't be able to live here, nor will most of the life forms on the planet. And it's ignorance about that, which is, I think, the major damage that economists have done is actually encourage that ignorance.
Steve King, thanks so much for being on my show. It's been really helpful. I know we dived into some, but the economics is what affects life.
Yeah.
It's been a great conversation. Thanks so much.
You're welcome.